Welcome. In this video, we are breaking down how 90% LVR SMSF loans let you buy investment property with just 10% down, straight from your super fund. Stick around to discover how this strategy could supercharge your retirement wealth.
All right, let's jump right into this. Welcome to today's Explainer, where we're unpacking a strategy that's completely changing how people look at their retirement savings. Have you ever wondered if you could secure a premium investment property using your superannuation, but without completely draining your fund's cash? Well, today, we are going to explore exactly how leveraging a self-managed super fund combined with a 90% LVR loan lets you enter the property market with just 10% down. It's a fascinating setup, so let's get started.
Here's exactly what we're covering today: taking control of your retirement, the 10% deposit difference, how to accelerate your wealth, eligible properties and financing, and finally, those absolutely crucial rules you need to follow.
Section 1. Taking control of retirement. The rise of SMSFs.
We're seeing a fundamental shift in how everyday Australians manage their nest eggs right now. To give you an idea of the scale, there are over 600,000 self-managed superannuation funds operating across Australia today. That is a massive wave. People are actively ditching the traditional hands-off approach because they want to be in the driver's seat. They want direct, hands-on control over their financial futures, and they want to decide exactly where their money goes.
Take Michael, for example. He's a 52-year-old SMSF trustee, and he put it perfectly. He said, the ability to direct his super into property investments has completely transformed his retirement outlook. He's building wealth on his own terms. And really, it's that desire for total autonomy, to invest in tangible assets that you can actually see and understand, that is driving this whole SMSF revolution.
Moving on to Section 2, the 10% deposit difference, breaking down the barriers.
Okay, so this is the absolute core of what we're talking about today. But first, let's just make sure we're totally clear on the terminology. LVR stands for loan-to-value ratio. It simply means the percentage of a property's value that a lender is actually willing to loan you. So if a bank offers an 80% LVR, they're funding 80% of the purchase price, meaning you need to come up with the remaining 20% in cash as your deposit.
Historically, SMSF loans were incredibly conservative. They usually capped out around 70% or maybe 80% LVR. Think about what that meant for a $600,000 property. At a traditional 70% LVR, your super fund needed a staggering $180,000 cash deposit. Even at 80%, you're still looking at a $120,000 barrier. But with the new 90% LVR model, that barrier drops drastically to just 60 grand. You can instantly see how this suddenly makes property investment a reality for funds that are still in their growth phase.
Let's look at how this plays out in the real world. Emma and her husband set up their SMSF in their early 40s with a pretty modest balance of about $75,000. Under the old rules, they would have been sidelined for years, making constant contributions just trying to save up a deposit. But because of that lower barrier to entry with a 90% LVR loan, their 75 grand was enough to lock down a $650,000 apartment.
Which brings us to Section 3, accelerating your wealth, the power of leverage. So how does borrowing money actually speed up your path to retirement? Let's run a quick side-by-side comparison. Imagine your fund buys a $500,000 property and it grows at a steady 5% every year. Fast forward 5 years and the property is worth about $638,000. That's a capital gain of $138,000. If you used an old-school 70% loan, you had to stump up $150,000 of your own cash to make that gain. That's a very solid 92% return on investment. But check out the difference. If you used a 90% loan, you only had to put down a $50,000 deposit to make the exact same $138,000 profit.
And that results in a jaw-dropping 276% return on investment. Seriously, 276%. By leveraging a much smaller deposit, you completely flip the math in your favor. You are now controlling a massive, appreciating asset while keeping your initial footprint super low. That is the accelerator effect of leverage working its magic.
But hey, it's not purely about the raw ROI. It's also about protection and flexibility. Robert, a business owner, highlights another huge benefit: maintaining a healthy cash position. Using a smaller deposit means your SMSF preserves its cash reserves. Instead of draining every last cent into a property, having that cash buffer lets you handle unexpected costs, cover potential gaps in rental income, or even pounce on sudden dips in the share market.
All right, Section 4, eligible property and financing. What can you buy?
Now for the practical reality. What types of property can you actually secure?
The good news is the list is surprisingly broad. You can go for standard residential places like apartments, houses and townhouses, or even residential land if it's tied to a construction loan. You can also venture into commercial real estate like offices, retail shops, or warehouses. But listen up, because this is the absolute golden rule. Neither you, nor your fund members, nor any relatives can ever live in the property. It has to be strictly maintained as a commercial investment to build your retirement wealth.
When choosing between the two, it mostly comes down to your risk appetite. Residential properties, especially those in standard metro areas, are generally preferred by lenders because they carry a lower risk profile and they're easier to sell if needed. Commercial properties, on the flip side, can deliver much higher rental yields, which is brilliant for your fund's income, but you've got to be prepared to jump through a few more structural hoops with lenders regarding their requirements and interest rates. As for the actual financing, the options will look pretty familiar. You've got variable rates, offering the flexibility to benefit if broader market rates drop, and you've got fixed rates, giving you total certainty in your repayments, which is fantastic for budget-conscious trustees. One thing to note, while 90% LVR loans do generally carry slightly higher interest rates, specialized lenders will often offer loan terms up to 30 years and even interest-only periods for the first 5 years, which is a huge help for managing your cash flow. Section 5. Crucial rules to follow: compliance and risk. We need to get serious for a second and talk about how to execute this safely. You're going to hear the acronym LRBA a lot. It stands for Limited Recourse Borrowing Arrangement. This is the mandatory legal setup for an SMSF loan. And the limited recourse part is literally your safety net. It means that if your property investment goes completely wrong and the loan defaults, the lender can only stake a claim on that specific property. The rest of your hard-earned retirement savings, your cash, your shares, they are legally shielded and totally untouchable. But even with that LRBA safety net, you still have to do your homework. There are 5 essential steps here. 1. Check your cash flow. Higher leverage equals higher repayments, right? Your fund needs the ongoing income to service it. 2. Make absolutely sure you're compliant with regulations. 3. Align the purchase with your fund's legally documented investment strategy. 4. Assess every single cost. Don't just stare at that attractive 10% deposit. Factor in lender's mortgage insurance and stamp duty. And 5. Get professional guidance.
Why am I stressing that last point so much? Because the Australian Taxation Office heavily monitors these setups. The property absolutely must pass what's known as the sole purpose test, meaning its only job is to provide retirement benefits to the fund's members. Just one single misstep in compliance can lead to severe financial penalties. So, teaming up with an experienced financial advisor, an SMSF accountant, and a specialized broker isn't just a good idea, it is entirely non-negotiable.
Well, that brings us to the end of our explainer. We've looked at how dropping the deposit to 10% drastically lowers the barrier to entry, and how leverage can seriously supercharge your wealth. But I want to leave you with this final critical thought to chew on. Does a 90% LVR SMSF loan actually align with your personal retirement strategy? It is a phenomenal tool, but like any tool, it requires a clear blueprint to work safely. I highly encourage you to chat with an independent professional to see if this is the strategy you need to unlock the next level of your wealth. Thanks so much for joining me today, and keep learning.